October 29th, 1929, 10:47 a.m. William Durant, founder of General Motors, one of the wealthiest men in America, stood on the floor of the New York Stock Exchange, watching his fortune evaporate in real time. He'd arrived that morning worth approximately $100 million. By noon, he'd lost $40 million, by market close at 3 p.m. He was completely broke. Not just broke, but owing millions to brokers who'd lent him money to buy stocks on margin. 50 years of building an automotive empire, gone in 4 hours of trading. At 11:30 a.m., a few blocks away, James Riordan, president of County Trust Company, walked into the bathroom of his office building, pulled a pistol from his jacket, and shot himself in the head. He'd lost everything in the crash and couldn't face his family, his wife, his depositors who trusted him. He was 47 years old, successful banker, pillar of his community, and Black Tuesday killed him before lunchtime. This was the day Wall Street died, and it took millions of Americans with it. If you want to understand what really happens when the stock market crashes through the eyes of people who lived through Black Tuesday, hit that subscribe button and smash that like button right now. Drop a comment telling me if you've ever lost money in a stock market crash. Because what happened on October 29th, 1929 wasn't just numbers on a screen. It was human beings watching their entire lives destroyed in hours. And the stories I'm about to tell you will show you exactly why market crashes don't just hurt portfolios. They destroy families, end lives, and reshape entire societies. Let me take you back 5 years before Black Tuesday so you understand how we got here. In 1924, the stock market started an incredible bull run. The Dow Jones went from 95 points in 1924 to 381 points by September 1929, a 300% gain in 5 years. Everyone was making money, factory workers were buying stocks, shoeshine boys were giving stock tips, housewives were day trading, and the prevailing belief was that stocks only go up. This time was different. We'd entered a new era of permanent prosperity. Sound familiar? The mania was fueled by margin lending. You could buy $100 worth of stock with only $10 down. Borrowing $90 from your broker, if the stock went up 20%, you made 200% on your $10 investment, leverage magnified gains, and everyone thought they were geniuses. Let me tell you about Edgar Smith. He was a typical investor in 1929, worked as an accountant in Manhattan, made $3,200 per year, decent middle-class income. But Edgar wanted to get rich like everyone else, so in 1928, he opened a margin account with $500, borrowed $400 from his broker, and bought $5,000 worth of Radio Corporation of America stock. RCA was the tech stock of the 1920s, the Tesla of its day. Everyone believed radio would change the world, and RCA would dominate. For a year, Edgar watched his RCA stock climb. By September 1929, his $5,000 position was worth $9,200. On paper, he'd made $4,200 profit, nearly double. He felt like a genius. His wife wanted him to sell and pay off the margin loan. But Edgar believed the boom would continue forever. He held on, and that decision destroyed him. October 24th, 1929, Thursday, later called Black Thursday. The market opened and immediately started falling. Panic selling began. By noon, the Dow was down 11%, the worst single-day drop in history. Trading volume was so heavy that the ticker tape fell 2.5 hours behind. Brokers didn't know what stocks were actually worth. Chaos ruled the floor. Edgar's broker called him at work. "You're getting a margin call. Your RCA stock has dropped. You need to deposit $2,000 by tomorrow, or we're liquidating your position." Edgar didn't have $2,000. His entire savings was the $500 he'd invested. He begged the broker for more time. The broker said no, sold his RCA stock at 3 p.m. for $4,100, paid off the $4,500 loan, and Edgar was left with nothing. Not only had he lost his $500 investment, he now owed the broker $400. Because the stock had dropped so much it didn't even cover the margin loan. But Black Thursday was just the beginning. Over the weekend, bankers met, pledged to support the market, told newspapers that the worst was over. And on Monday, October 28th, the market opened higher. People believed the crisis had passed, then selling resumed by Monday's close. The Dow was down another 13%, and Tuesday, October 29th, Black Tuesday became the day that defined a generation. The market opened at 9:30 a.m. and immediately collapsed. There were no buyers, only sellers. Everyone was trying to get out at the same time. Stocks that had taken years to climb crashed 50% in minutes. Millionaires became paupers before lunch. Fortunes that took decades to build vanished in hours. Let me tell you what happened to Winston Churchill. Yes, that Winston Churchill. He was visiting New York in October 1929, staying at the Savoy Plaza Hotel. He'd invested heavily in American stocks. On Black Tuesday, he went to the stock exchange to watch the trading, stood in the visitors' gallery, and watched his entire American portfolio get annihilated. He later wrote, "I witnessed the suicide of prosperity." He lost the equivalent of $5 million in today's money. He was 54 years old and financially wiped out. He spent the next decade writing books and giving speeches to rebuild his wealth. The crash delayed his political career by years because he had to focus on making money just to survive. Or consider the Rockefeller family. Even they weren't immune. John D. Rockefeller Jr. lost $80 million on Black Tuesday. Granted, he was still worth hundreds of millions after the crash, but 80 million gone in one day. And Rockefeller was sophisticated, diversified, had the best advisors money could buy. If it happened to him, it could happen to anyone. But the real devastation was among ordinary Americans who'd put their life savings into the market. People like Clara Green, a 52-year-old widow living in Brooklyn. Her husband had died in 1927, leaving her $8,000 in insurance money. Her only source of income, her broker convinced her to invest it all in stocks. You'll earn 20% per year, much better than bonds. By November 1929, the $8,000 was worth $1,400. Clara had lost 82% of her life savings. She had no income, no job skills, no safety net at 52. She had to move in with her daughter and son-in-law, becoming dependent on family charity for the rest of her life. The suicides started immediately. Contrary to popular myth, stockbrokers weren't jumping out of windows in large numbers, but the suicide rate did increase significantly. James Riordan, the banker who shot himself on Black Tuesday, was one of dozens of financial professionals who killed themselves that week. Some jumped from buildings, some shot themselves, some turned on the gas in their apartments. The shame of losing client money, of bankruptcy, of failure was too much to bear. But the real tragedy unfolded over the next 3 years. The crash of 1929 triggered the Great Depression. By 1933, the stock market had lost 89% of its value from the 1929 peak. Unemployment hit 25%. Over 9,000 banks failed. Millions lost their homes. Breadlines stretched around city blocks. And the crash that started on Black Tuesday led to a decade of misery that killed hundreds of thousands through malnutrition, suicide, and despair. Here's what most people don't understand about Black Tuesday. The crash didn't happen because of fundamentals. It happened because of psychology and leverage. In September 1929, American companies were profitable, the economy was growing, unemployment was low, nothing fundamental had changed, but stock prices had gotten completely detached from reality. Radio Corporation of America was trading at $505 per share with earnings of $140, a price-to-earnings ratio of 360. That's insane. The company would need 360 years of earnings to justify the stock price. But nobody cared, because everyone believed someone else would pay even more, the greater fool theory, until one day there were no more fools, and the pyramid collapsed. The leverage made everything worse. When stocks were going up, 10-to-1 margin magnified gains and everyone got rich. But when stocks went down, 10-to-1 margin magnified losses and wiped people out completely. Edgar Smith with his RCA stock is a perfect example. He invested 500, borrowed, fourth, 500. And when the stock dropped, he lost not just his 500, but ended up owing money margin calls, forced selling, which caused more price drops, which caused more margin calls, a death spiral that couldn't be stopped. And by the time it ended, 90% of the leverage in the system had been wiped out, along with the people who'd borrowed it. So what's the lesson from Black Tuesday? First, never use significant leverage to invest. Margin is financial dynamite. It amplifies gains, but it also guarantees you'll be wiped out in a crash. Edgar lost everything because he borrowed 90% of his investment. If he'd invested only his own $500, he'd have lost $400, but he wouldn't have owed money. Second, if everyone you know is talking about the stock market, it's probably time to sell. When shoeshine boys are giving stock tips like in 1929. When Uber drivers are talking about options trading like in 2021, those are signs that dumb money has entered the market and the end is near. Smart money sells to dumb money at the top. Third price-to-earnings ratios matter when stocks are trading at 50, 100 or 300 times earnings. They're overvalued, period. Doesn't matter what growth story you believe. At some point, gravity reasserts itself and prices crash. RCA went from $5.05 to $9 over the next 4 years. A 98% loss. Fundamentals always win eventually. Fourth, crashes happen faster than you think. Black Thursday to Black Tuesday was 5 days. Edgar Smith went from feeling like a genius to bankrupt in 48 hours. You won't have time to react when the crash starts. You need to be positioned correctly before it happens. In trying to sell during a crash means selling at the bottom to the few people still buying. And fifth, crashes don't just hurt the rich. They destroy the middle class. The Rockefellers survived Black Tuesday. They lost 80 million but still had hundreds of millions left. Clara Green, the widow, lost 82% of her life savings and ended up dependent on family charity. Crashes are most devastating to people who can least afford to lose. If you found this valuable, smash that like button, subscribe for more true stories from American financial history, and share this with anyone investing in the stock market today, because Black Tuesday 1929 was the worst day in Wall Street history. It triggered the Great Depression, destroyed millions of lives, and the patterns that caused it, leverage, mania, detachment from fundamentals, happen in every generation. We saw it in 2000 with the dot-com bubble. We saw it in 2008 with housing. We're seeing signs of it again today. Learn from Edgar Smith. Learn from Clara Green. Learn from the millions who lost everything on Black Tuesday. Because those who don't learn from history are doomed to repeat it. And the next crash will be just as devastating for those who aren't prepared.